Hello, and thank you for joining this third webinar from Satori Insights. Once again, there's a puzzle in markets. And once again, I think if we take a slightly unconventional approach, then maybe we can find a little bit of enlightenment. So the puzzle is obviously the way in which this great big backup in bond yields we've been having is seemingly having so little impact. It's the same puzzle you could see Jay Powell struggling with on the FOMC last night. Both nominal and real yields are back up towards the highs that we saw in October, November. And yet, until very recently, credit spreads were really on the verge of 2007 tights. Equities were close to making new all-time highs. And again, the magnitudes are really quite striking. So when we were last back with, say, 10-year treasuries at 460 in October, November, equities were 15% lower. Investment-grade credit spreads were 35 basis points wider, even with the recent sell-off that we've had. So how is it that last November, the yield backup was just having such a serious impact, and then this year it simply hasn't? It's almost like views on inflation. They seem to be all over the place. It can't be the real yield versus nominal yield breakdown because they've both been moving upwards. And it kind of begs the question, is it just a question of waiting a little bit longer until we hit some magic level, or for the passage of time, and then you finally have the impact coming through? Or conversely, are we supposed to be buying the dip? Or maybe is there some other mechanism which has been at work in the background? And I think the standard explanation that people tend to come up with, and again, is what you heard from Powell last night, is it must really start from the stronger economy. They say the economy has to be stronger. Maybe it's because of fiscal stimulus. Maybe it's because of higher productivity from AI. Maybe it's because of immigration in the US. But a stronger economy is really the only way that they can rationalize this lack of impact that the high yields are having. If, though, it is a stronger economy, then there are a whole load of things that don't make sense. How come default rates keep edging upwards? How come there's all this gap risk on triple Cs in credit? How come so much of the move in the equity market has come from the PE side of things rather than earnings? How come those levels of corporate credit growth in particular are really so muted at this point? How come there's a relative lack of M&A? Normally when you get a boom in markets, you get a boom in M&A. There's lots of things that don't quite fit with that explanation. And it seems to me that there could be something else going on here. Similarly, the IMF wrote about this in their financial stability report. Maybe you saw it a couple of weeks ago. And they said, maybe it's that the market is expecting easing to come. Maybe it was the Powell pivot in December. And perhaps that was a good explanation at the time. But of course, what have we done over the last few weeks? We've basically dialed back globally on all those expectations of easing. And yet, until very recently, there was barely any impact on risk assets at all. So what I'm going to try and do today is convince you there's a better explanation, one which doesn't put the economy first and puts markets first instead, and money flows first. And to do this, I'm going to run through this presentation, which should take about 25 minutes or so, and then I'll move on to extended Q&A. And as I've done previously during the Q&A, I'll pull up quite a few additional charts and things from my macrobond chart library. Now, the presentation itself is actually one I prepared for a meeting at the ECB last week. And so it attacks things from a slightly different angle. It says, why are financial conditions so benign? And it doesn't deal with the outlook directly, but you'll see there are implications for the outlook the whole way through. And I'm sure when we get to Q&A, you'll bring me back to the outlook rather directly. So you can type in questions at any time on the chat in Zoom, or you can raise a virtual hand at the end and I'll enable you to ask them directly. So with that, let's dive in. I've divided the presentation into three parts. First, we'll look at the evidence of exuberance in markets. Then we'll look at that standard explanation of the stronger economy and see why it doesn't really fit properly. And then finally, we'll look at what I think it is that's really going on and begin to trace what the implications might be for the outlook. But if there's one thing that I hope I can do in the next 25 minutes or so, it's as I said to the ECB, it's to convince you that even if there's no immediate sign of a blow up, even if actually in most respects, I'd argue that the outlook is for the exuberance to become even bigger, that doesn't mean everything's okay. actually, there's a lot that we or they should be worrying about. But as I say, I kind of think that the exuberance is going to carry on. So I'll go quite fast through the slides, especially in the early part of the presentation where I suspect the arguments will be more familiar to you. And then I'll slow down a bit later on when we get to options skew and global liquidity and stuff like that. So with that, off we go. So it's almost funny as you read article after article on Bloomberg or elsewhere saying, wow, it's almost as though the easy money never stopped. And you look across markets and yes, there are lots. I don't think it is 2007 all over again. There are lots of differences relative to 2007, but it is striking on a number of indicators, just the degree of similarity. So credit spreads in particular, probably actually more so for high yield than for investment grade. Similarly, volatility levels, they're all really, yes, equity vol has picked up very recently, but there are all these sort of uncanny echoes of 2007. And as we'll see later on, I don't think it's a coincidence that much of this echoes what we got used to in the easy money era. But of course, what's weird about this, at least as far as the central banks are concerned, is that for several weeks at least, if not longer, they think they've been tightening and been relatively aggressive and relatively hawkish, whether that's with the rate rises themselves, whether that's with reduced expectations of rate cuts later on this year, that all of the central banks have been dialed back on. Even the ECB almost certainly is going to cut in June, but it's ambiguous thereafter as to how much we get. And of course, in their minds, they've been carrying on doing QT the whole time. Yes, the Fed's announced a slowing, but the puzzle as far as they're concerned is, well, we've been doing this the whole time. That should constitute tightening. That should tighten financial conditions. And yet markets have just shrugged it off almost entirely. And about the only place that there seems to be any kind of concern on the part of market participants at all is in govies, whether that's the backup in nominal and real yields, or whether it's also in levels of volatility, which are a bit more elevated. At least in govies, it doesn't feel as though it's 2007. But that's really the exception rather than the rule. The other thing, of course, that's funny is the price action in Bitcoin and the price action in gold, and people are speculating as what's behind that. In some respects, they're quite different. In other respects, those are the sort of safe haven trades that people sometimes talk about when they worry about too much easy money and a refuge from future central bank easy money. And again, I don't think that's a coincidence, and we'll come back to that later. But broadly speaking, I would say away from the government bond market, and until April, risk has been on fire across the board, and central banks are scratching their heads about it. And the financial stability teams everywhere, I think, have been trying to come up with different explanations, and they're all a little bit unsatisfying. So one theory that you sometimes hear is, oh, maybe there's too much vol selling. Maybe we're supposed to worry about all these zero data expiry options in the equity market. There's a nice piece that Ruffer has written describing many of the dynamics in that market. But as I look at that, yes, it's one of the dynamics, but if it was really that dominating the price action, I should see it in vol, but not in things like credit spreads, or I should see it in equity vol with this large retail component. And instead, in credit vol, which is really a very institutional market, actually what we see is the same thing. Or similarly, if it was all about this sort of artificial depression of risk premia and volatility because of some trading that people were doing, then you would say actually implied levels of volatility should be really very low. And instead, when we look across the board, whether it's in credit or equities or elsewhere, it's realized vols away from govies, which have been very low. It's that which has been dragging down the levels of implied vol. And as such, actually, no, there's something deeper going on. There's some characteristic in the underlying markets. The next explanation that the central banks usually come up with is they say, oh, maybe it's the hedge funds, maybe it's something distortionary going on the hedge fund side. That doesn't really fit to my mind either. There has been a pickup recently in betas as measured by some of the CFTC numbers in equities, but generally speaking, for most of the rally, and even now, I would argue positions and leveraged positions generally have just not been as large as all that. And where they are large, they don't seem to be taking lots and lots of beta. And so, yes, you see things like measures of margin creeping back up, but they're not outrageously high relative to the level of the equity market, let's say. And it's not at all obvious to me that it's that which is the source of all of this exuberant price action. Likewise, when we look at things like gold, which again is a little bit of a wobble recently, but it's not obvious that it's the spec longs that have been driving that. And maybe come back to that later on. And similarly in Bitcoin, fund flows are maybe different, but leverage as such, leveraged players, to my mind, that isn't really what's going on. Where you do have them, things like the basis trade in US Treasuries that people have written about, then there too, if anything, there's been a little bit of a reduction recently. And I don't see that as a major source of financial stability risk at this point. I think there are other things that are a larger concern. So as we put all of this together, we come back to this sort of remarkable conundrum that financial conditions varies a bit depending on which index you take, but say on the Bloomberg indices, they're as easy as 2007. They're easier than at any point they've been over the last decade. And this in an environment where the central banks think that they're running restrictive policy. It was very interesting how Powell kind of ducked that question last night, and I think not very convincing at all. I would argue actually there's strong evidence that easy financial conditions do feed through into better GDP, generally speaking. And so maybe one reading of all of this, if you're in financial stability at a central bank, is perhaps we don't need to worry. Perhaps the markets are just leading and the economy is going to follow along behind. While I do think there is mostly a positive implication for economic growth, actually I'd argue it's more concerning than that when we look beneath the surface. And that's what we're going to turn to now.